All right. Let's begin. So today is probably one of the toughest. We do have computation of global income or losses, and we do have adjusted cover taxes all in one day. So it's going to be a tough one, but it's a really, really relevant class for us to get a grasp on how do we calculate this thing, the profit, and also the cover taxes. And then on Thursday, we'll see how we calculate the top up. So these three are, in my view, the main issues. Obviously, allocation of the IR, etc., things that we have seen already are relevant for applying the rules, but these are the core issues that will surge when you apply on a day-to-day practice. So I have the honor of having here Leonardo Aguirre, professor of IBDT, to help me with this topic. Today, he will talk a little bit about the computation of global income and losses, and then we'll discuss it. And then afterwards, I will talk about the computation of the adjusted cover taxes. If we don't finish adjusted cover taxes today, no worries, because we can take up a little bit of the time tomorrow to make up for what we didn't finish today, if any. Tomorrow, just remember you have mainly tax incentives and how do they play out with Globe, but we'll talk a lot about qualified and non-qualified refundable tax credits, non-refundable tax credits, and these are particularly relevant both for the computation of global income and the computation of the covered taxes, because depending on if they are qualified or non-qualified, they will act in one way or the other. So today is very relevant to understand what we're going to see tomorrow, but if the adjusted covered taxes we don't finish today, we can finish it tomorrow in 1 hour. All right. So without further ado, Leonardo, thank you very much for being with us. It's a real pleasure and a real honor, and the floor is yours.
Suggest to switch to the American. I think it's oh, thank you. Technology. Hi everyone. First of all, I would like to thank Professor Schwed and Professor Vettori for this kind invitation, and I'm super thrilled to be here again in our house. It's a opportunity to discuss Pillar 2, which was my postdoc issue under supervision of Professor Schwed. So it's something important in my life today. And I will discuss a very specific topic here regarding the article or chapter 3 of the model rules. That's my scope here. And first, I will like to put my agenda. It's not necessary just to separate my speech in 4 parts. But the first very beginning step I would like to cover with you is about the tax policy. Because we've go in deep in the wording of the chapter 3 without understanding the tax policy, I think we're gonna make some mistakes about understanding the real meaning or the facts in the behind the scene, or starting thinking about only wording. I think it's a mistake. We have to consider the whole scenario, the context of Pillar 2 to understand the Chapter 3. That's the first important beginning. And I put some ideas here to discuss this tax policy, specifically regarding the globe income concept. And my first question for you, if you want to participate, I invite you and strongly recommend. Is there a universal concept of income? What do you think about that? We can construct a universal thing in terms of definition of income, or what we're dealing here is something created by OECD, and we are struggling with the parliaments to impose a kind of concept. What are you thinking about that? And move on, please participate. Maybe we have to use the microphone. I don't know. Yeah, they need to. Gabriel. No, microphone. I don't know if it works in our dynamic here, but just to warm up.
I think there is somehow a concept of income that could be universally accepted. For instance, the principle of realization, something that I think every country shall analyze and decide whether in their internal system they have to apply or not. So I think that there are some concepts, but each country will decide whether, according to their constitution, their experience, some items of income should be taxed or not. But the concept, the main concept, which means uh, an increase in your assets or uh, indeed earning an income, those concepts, I think that they are universal. But of course, because countries are different, some concepts may be different. So I would say yes, with some exceptions.
So it's not a universal, Professor Schmidt.
To mention concept of income or notion of income. Because when you use the idea of concept, it seems I think close, clear. Notion, and why I'm using the word notion? Because the European Association of Tax Law Professors, some years ago, I believe 10 years ago, they made this question to several professors in Europe. What's the notion of income? And there's a book, The Notion of Income. And they seem to agree in some ideas of this notion. That means we know what it is, but not concept, because concept would mean, well, it's uniform, and there's no uniformity. But the notion, I would say yes.
It's a trick question to relate it to idea of type or some group of features. Maybe you can say this realization. It's one item of this group of features, but
Which, for instance, if you go to the United States and you talk about this, they may have some doubts on it also. You have taxation on accrual income also. So realization, and you know the Morse case and so on. It's not obvious that you need realization to say that there is this notion of income.
that's the main idea. I think that because we have to deal with the definition of income. So for every country, that's the main intention from OECD. So that's the first step that I would like to put in your head.
Europeans also, they tried before this Pillar 2, they tried to find a common consolidated tax basis, the CCTB, for Europe, and they worked a lot, and they never reached it. And that's why this is not surprised. Sorry, we're here. It's not surprised that when you're talking now about Pillar 2, they're accepting, well, get the notion or get the concept of the UPE. And it will not be the same in other countries, but no problem. I mean, not even Pillar 2 believes there is one single concept acceptable for everybody.
Since we have a very illustrated idea that we don't have the concept of income, a universal concept, you can thinking about the necessity to create a pattern of the concept of notion of income. Why do you need this kind of necessity, and what is exactly the right that it has been restricted here? Because when you're thinking about the pillar 2, you have to see clearly that one right here that has been restricted, that is the right or freedom of to create a tax planning. That's the main idea here. because we're living in a process of restriction of this liberty to create international tax planning. That's the main idea here. Putting it in your head, it's something easier to understand the move steps.
Sorry, tax. Do you think that Pillar 2 has to do with tax planning? I don't. I really don't. I really don't. I believe Pillar 2 has to do with the competition among jurisdictions. And they are kind of offering, because it's not, you cannot call it a tax planning, because tax planning has the idea of somebody, let's say, sailing through jurisdictions to escape taxation. And what you see is jurisdictions that they're not escaping; they are offering you. They're saying, "Come on, you're not supposed to pay tax. Why are you there? Come here." There's not. It's different because it has nothing to do with tax avoidance. It has to do with.
Sure, I think if we're not talking abusive tax planning, we're just talking planning, and planning is change of behavior due to tax. That's the definition of planning. So if I'm changing my behavior with investment, I'm still reacting to tax competition. So reaction to tax competition is tax planning. So it's okay. I still think that this thing is a floor on tax competition, but indirectly it's not targeted at abusive tax planning. It's just
If you're saying, because of course every movement I'll make, every movement I make at least has a tax reason for this. If you call this tax planning, if your concept of tax planning means reacting to taxation, we are all tax planners here. We live tax planning. Usually, when you talk about tax planning, it's much more than this. It's trying to analyze, look for loopholes and so on. So what you called abusive, which I called user, but it's a
Fair. To warm up, I think it's very. My intention is getting achieved here to warm up, but they are quiet. So, thinking about the pattern of income, maybe we have the different ways to restrict the movement to reduce tax in general. That's my personal perspective over here, and that's why I think Pillar 2 do yes is related to international tax.
you know, sorry, I want to insist on this because when you have this jurisdictional approach, especially, then it has nothing to do with what one taxpayer is doing, the other is doing, whether the jurisdiction is taxing or not. It's, I mean, the scope. Sorry, of course, I have a huge influence. I'm really convinced of what Ricardo wrote in his thesis, and he proves it is not a tax avoidance issue. It's merely tax competition.
Not a tax avoidance, it's tax planning, just planning. The third one is there any difference between income and profit in this context? In general, there's no relevance internationally, but in some countries, in Brazil, maybe we have a problem with this. There are different concepts here, and when we're thinking about globe income, we're thinking about income, tax income. But in some countries, we have the local thing regarding profit, and our additional CLSL is on profit, not income. Maybe it's a kind of deviation from Pillar 2 concept, but is regarding our concept of global income here. Is maybe we have the discuss in the future about availability or realization, and makes sense to create a difference between these two concepts. And the last one, who is the taxpayer? I think it is the most relevant question here. Who is the target of this rule, and what kind of activity this taxpayer has been dealing with? When you're thinking about the carve-outs, for example, there are some aspects you have to understand. There are a kind of company on the target.
This is something which should be mentioned when we're having this class in English, and that's why we're saying who's the taxpayer, who's the taxpayer, who's the taxpayer. But just pay attention that we in our literature have a differentiation between the person who incurs in the taxable event, which we call contribuinte, and the person who is subject to tax, which we call sujeito passivo. The word taxpayer can fit both. And I'm just saying this because sometimes, because most of the literature is made in English. So when you ask who is the taxpayer, you must be more clear. Are you asking who is supposed to pay the tax? And I know who is supposed because this is clear. Another question is who is incurring in the situation foreseen by law as a taxable event? I think your question is the second one. I mean, who incurs in the situation? Whose ability to pay is being seen if, and Ricardo comes again to me, sorry, to say, are we looking for ability to pay?
Yeah, that's the main question. I think it is the most relevant question here in this class because when you identify the approach in which pillar, you can see clearly a separate entity approach for a part of this project. Pillar 2, for example, it's a separate entity approach for QDMTT, for example, and pillar 1 and a global approach that in which we will treat a taxpayer as a one M&E as one thing, one taxpayer without this segregation. That's the idea to analyze the global income, because when you is trying to when you are trying to that's a very important perspective, because it's rare to see in literature, even in international literature, differentiation between the who is earning this globe income and who is in charge of the payment of this tax on this income. This differentiation is super relevant here, and I think these 5 tax policy questions are sufficient for our warm up, and now we can go in deep in the model rules, and then we will use naturally here 3 sources: the model rules in 2020, the commentaries in 2022, and consolidated commentaries in 2024. That's our literature that we're using here, and our task here is deal with the chapter 3, as I said, the globe income or loss. And the definition of globe income or loss in Article 3.1 is super easy, super clear. It's based on the financial accounting net income or loss, the term for the constituent entity in a fiscal year. And you have a bunch of adjusts in Article 3.2 until 3.5. That's it. And we have a lot of definitions to deal with this, and going to the wording sometimes is easier as this 2, and sometimes it's a little bit tricky because the wording is confused. It seems a confused translation sometimes. But here is super easy, and the financial accounting is the base, is the source, and the account will provide the starting point for this assessment. So what is relevant? Why this is relevant? So thinking about the formula of ETR, we can see the net globe income in one jurisdiction is the denominator. So we'll have the globe income minus globe losses, and you will sum of all constituent entities in one jurisdiction. So this is important because the higher the net globe income, the lower the ETR will be. This construction is super relevant because if you trying to, and there are 2 very interesting texts recommending the for you in the paper, and they're discussing this thing, if you try to adapt or alter your financial account to reduce your net globe income, probably will have the lower ETR, and with a lower ETR, you will pay more tax. This relationship within this formula is it's important to understand the mechanism here. The high, oops, the high. Let repeat. The higher, it's a kind of mathematical thing. A higher net income, the higher the lower ETR. If you have a lower ETR, you pay more tax because you use the ETR to compare to 15% of income tax. Acho que agora parou aqui. Agora foi. Então, so the starting point is exactly the financial account. Something relevant here is the number that will the number stems from the account adjustment is assessed before the consolidation in one jurisdiction. That's a relevant part here, and it stems from this article 3.1.2. Eliminate. So you have to eliminate the intra-group transactions. One of these adjustments is for eliminate these intra-group transactions to achieve this globe income. And the last one, the source of information is the account. Before any consolidation, the opposite. Sorry. Yeah, before any consolidation, eliminating intra-group transactions.
Explain this. When you consolidate, you must eliminate all intra-group transactions. Why? Once you are consolidating, you assume this unitary approach. So the entity is not the legal entity, but is the group as a whole. If the entity is a group as a whole, transactions intergroup simply have never happened. So for purpose of consolidation, you get the balance sheet and you eliminate the intergroup transaction. This is the only way of consolidating. So what they're saying is you get the results before you get the results you get the accounts just as if you were consolidating. That means following this, because for you to consolidate, you must adopt for both companies the same patterns. Otherwise, you cannot consolidate. So you adopt the same patterns. You calculate, but if you were to consolidate, you would calculate and eliminate the intergroup transactions. What they're saying is stop. You consider before eliminating. So it's one step before consolidation.
Perfect. Much better. And this perspective is totally related to idea that the account financial worldwide standardized is the International Financial Reporting Standards, the so-called IFRS. And there are a bunch of reasons for use this IFRS because many countries use that. It deals with the consolidation information in a proper way. So IFRS, it's a very considered the acceptable accounting standard. And but you can use other source there here. When you can use other financial accounting sources, there are 3 criteria. The first one is the accounting standard for all the group. The second, it has to be considered reliable. It's not clear who will assess the reliability.
There is a list of reliable ones. politically or not, because you see some countries, there's a list of reliable, Brazil is there, but also Russia is there. So you see that the reliable has something to do with policy on this, but they have listed what would be reliable. To say that in principle you would use the the gap which is of the used by the UPE is because the whole idea they have is let's be practical. If you belong to a group, you certainly must prepare your subsidiaries accounts according to your parent company, because the parent company will demand this to you because the parent company's jurisdiction shall require this for purpose of consolidating there. So they say, since you're already preparing according to your parent company's gap, follow the same.
And the third one is related to the permanent differences. It's the minimum trigger here is the SAS 1 million euros, but the main idea is that it has to be conformed to the treatment required under accounting standard using a consolidation financial statement. Exactly the UPE idea. If you dealing with your UPE accountant standard, okay, I accept an error below the threshold of 1 million euros. Someone has no, just microphone, please.
And the slide before the elimination in the consolidation process,
Here.
I think it's already the elimination that the mechanism of consolidation financial statements already provide, no?
That's it. That's what I'm saying. Yes, it is. That's what I'm saying. Before you do it. So just written, before, you're right. In order to consolidate, you must eliminate the intergroup transactions. You're correct.
Yeah.
So they're saying, don't do it for purpose of globe. Get the number before doing this. You're correct. In order to consolidate, I must eliminate transactions between companies. I agree. Okay?
Okay.
So they're saying, so we have several steps for consolidating. The very last step is eliminate intergroup transactions. So they're saying, don't follow the last one. Get the number before this one. This is the number you need.
Okay.
Because they want to know what would be the result in the jurisdiction. And since it is a separate entity approach, in the jurisdiction from separate entity approach,
Okay.
you had this gain or loss.
Okay. But when you are okay, but if you are in a parent and subsidiary in Brazil, I think this is elimination is not necessary.
Okay, not necessarily. Because,
Okay,
no, within the jurisdiction, you have no problem.
Okay,
Remember jurisdictional approach.
Not only that, if you have intergroup transaction between jurisdictions, you need to adjust for transfer pricing. So this is transfer pricing reliant, and that thing that Pillar 1 is dead, and if Pillar 1 is dead, how reliant can you be on transfer pricing if the main thing of digital economy, which this is supposed to be dealing to, hasn't been resolved yet? So it's Ruven has a paper regarding that. So because this is fully transfer pricing reliant, you can't run away from it.
And here we have the list of the concept of the generally accepted accounting principles: Australia, Brazil, Canada, Russia, or China. So we don't have the certainty. Maybe I think it is. I don't know the size of this. That's right. The wireless one.
But if the investor use the US gap, I still can use the BR gap here, the IFRS.
Yeah.
So you must follow, for purpose of globe, for this calculation, all the companies must follow the same gap. So if you would consolidate, you would follow the same gap. You can never consolidate if you have different gaps. Never, from an accounting perspective. Okay? So the idea is all of the companies of the group shall follow the gap of the ultimate parent entity. Clear? Otherwise, it doesn't work.
Yeah. but the United States of America is on the list here. And that's the point. Maybe you're trying to. My concern with that.
Gustavo's correcting me incorrectly, saying that after this was done, they created the QDMTT. And when they create, because remember, this process is not to say that they had something done. It was negotiated step by step. QDMTT was not foreseen when they were discussing IIR or UTPR. Okay, it came later, and due to political discussions, for purpose of QDMTT, they admit either you follow the UPE's GAR or the constituent entities GAR, which which means you're right, sorry, which means that there may be, because of this, there may be even a difference between the amount of the QDMDT, which may be calculated according to the local gap, and the IIR. Why I'm saying this? Because theoretically, if you would charge QDMDT, there would be nothing to be paid as IIR because the QDMDT would cover. But since QDMDT may be calculated according to the local gap, it can be higher or lower than the amount which would be calculated by the ultimate parent entity's jurisdiction. So there may be some residual IIR because of this. I mean, ideally, I think correctly, technically, would be maintain the same rules. If you're demanding the parent company's legislation for purpose of IIR, follow this locally. But then negotiation, smaller jurisdictions would say, come on, how can we know how to calculate according to the Russia's gap? I don't have this idea. Then they negotiate, say, okay, adopt this QDMTT. The problem is this, that they will not match.
Just one thing, you're 100% right. And in this case, you have a NIR credit for the QDMTT, and there might be something left to collect unless you fall within the QDMTT safe harbor from the annex of the commentaries. Then you shut it off, but the safe harbor has a more strict gap rules that are acceptable, and IFRS, of course, is there. So we're safe for the safe harbor.
And there are more two tax policy questions that have been discussed. And this context is there room for gap shopping, for example, in the competition among countries to attract direct investments based on these differences? Yeah, for repeat. Yeah.
Unless you're talking about tax inversion, you don't have.
That's exactly.
Unless you talk about tax inversion. If you know what the concept of inversion is, not? That you change the jurisdiction where the UP is. Then, of course.
That's the main question. There's a loophole to fulfill in the future. I don't know. So to sum up, so the financial account income and loss will be the starting point to determine the global income. You have some adjustments. So now we have to go in deep into the adjustments. The last reference here, where there are a bunch of countries and where use the commercial law as the basis for this source. In Brazil, we have already overcome the process of internalization of the IFRS, but in some sectors, for example, energy, bank, we have some distinctions, and this kind of adjustments maybe will be considered here. But we will have the same adjustments. Regardless of the source of information, we have to see the process of to be under IFRS without any exception. That's the main idea here. That I already said. So the adjustments. The first start here is we have the different treatment compared to the accounting treatment and tax treaties. Tax treatment, tax treaty is another class. And we have all these adjustments in Article 3.2, and this will be 11 provisions related to these adjustments. I think the most relevant one is the first one, the 3.2.1, in which we will see the required adjustments to the financial account to achieve the tax information, the acceptable tax information. And there are a lot of them. I think Gustav said we will have the next class regarding the qualified refundable tax credit. So we'll avoid this tricky point. And this class will see some points. We don't have time to see everything here. I selected just a list of the adjustments, and I'll put some comments about one of them, or two maybe. So the list, this is the list. We have 9 adjustments to achieve the globe income from the financial accounting source for information. We have to adjust net tax, excluded dividends, excluded equity and gain and loss, valuation and method gain or loss, some disposition related to liabilities. This letter F, I think it is the most tricky ones because it's a symmetry foreign currency. The currency is a super problematic topic. Policy disallowed expenses is a little bit easy because it's bribe, it's penalties, it's Professor Schwedi has some comments about this because his literature. But I think it's maybe we're moving forward universal notion without bribes, without penalties or something related to undue activities. And change of accounting principles, that's not really relevant, but it's more for the temporary adjustments. And the last one is accurate pension expense. Looking at these 9 items, I think it is asymmetric foreign currency is the most relevant, and maybe the net tax expense. And Gustavo will treat when we're talking about the adjusted cover tax. So just one comment about the currency. We have here a treatment with bunch commentaries by OECD, and we had the problem around the world, and that we will not see in Brazil. In Brazil, it's super easy because in general we do our exchange through dollar, and it's a little bit easier because we had the very clear rules about that. But when you, for example, go to the China or Russia, they use 7 or 8 currencies officially. So maybe you have a problem for companies in that jurisdiction. In Brazil, it's a little bit easier. It's almost mandatory in commercial practice. So it's a little bit easy. But
I've already worked with taxpayers with these functional numbers, functional books, and you have they call functional currency, and this brings some troubles.
And we have here a definition of tax functional currency. Is the functional currency used to determine this constituent entity taxable income or loss for cover tax in the jurisdiction in which it is located. That's a little bit the definition is easy, but in practice a little bit difficult because we have problems. I have some clients with this problem now because when you 3 levels of recognition of different currencies, for example, Chinese, UK, and Brazil. And Brazil is UP, and we have to exchange to harmonize in the same date all assets or income or loss. But the date of recognition or the end of the year in which country is not the same. For example, in UK is April, in China December, in Brazil December. So you have to uh, create a kind of proportional recognition and separate the year in two parts. There is a commentary specifically regarding this thing, and sometimes it's hard to create a proportional recognition because we don't have in our Brazilian um, normative instruction this kind of proportional rule, and we have the in commentary. So it's a lack of Brazil normative instruction, and we at EBDT recommended this kind of fulfill of rope hold, and it was not accepted. So just for a register. The second adjustment is related to compensation. It's stock-based compensation. It's a kind of a temporary difference because if you have the stock plan compensation in which you recognize an expense uh, in at the beginning of the plan, and for example, the employee was fired 2 months after the beginning of the planning, and there is no option, there is no transaction with the employee, and there are a lot of different treatments around the world about this, and the OECD created a kind of harmonization of when you have to recognize this kind of expense. Sorry.
My question is whether the deduction that I should recognize is the fair value of the stock, because I have to evaluate during the period by, I don't know, Black and Scholes or another method. But the fair value is very different from the amounts that I have to deduct in the end of the day, because the amounts that I pay in this stock-based compensation may be different from the fair value of the stock. So my question is whether I have to, this provision is related to the fair value of the stock, or to the deduction that.
I think it is deduction. I think it is the moment of the deduction. It is not exactly the fair value, but there are some comments in the commentaries about the fair value, and I think that when the option is not possible anymore, you have certainty about the value, so you have to recognize the fair value at that moment. That I remember about commentary regularly. It's super specifically this thing. The third one is regarding the arm's length. The arm's length adjustment is required when the transactions are not recorded in the same amount in different entities, or the transaction is not consistent with the arm's length principle. So we can identify these differences when we'll have, for example, a unilateral APA, and with specifically treatment and that jurisdiction, it is not the same in the whole group, Professor.
Of course, when you consider, when you talk about usually tax bases, it is possible that due to transfer pricing, you may have an economic double taxation, because you make an adjustment in one country and the other jurisdiction not necessarily will make the same adjustment. However, when you talk about consolidation, so on, well, in pure consolidation, this would not be a problem because the transfer pricing, the intergroup relationships would disappear. However, here you are in something different because you are before the adjustments. So I think, and I think I read it, that for purpose of globe, you necessarily must have the same adjustment in both jurisdictions. I mean, the idea you cannot assume only correcting one side and not the other. But I think I read this. I don't know if I remember because I remember having seen this because otherwise it makes no sense. You need to make you need. I mean, you must. It's unacceptable that you would adjust in one side and not the other. Otherwise, the global income as a whole, because remember, for you to calculate, you need you may need also the income of the whole of the global income, and it would be wrong.
Even if in real transfer pricing, you're doing something different. Even if like the other country doesn't allow for full arm's length under the internal law, you're doing a globe transfer pricing adjustment, which is not necessarily your transfer pricing adjustment. At least that's how I see it.
I mean, one thing is your tax basis, another thing is your global basis. They are the same idea, but because here it is necessary, otherwise it doesn't work.
Yeah.
No, I was just going to say what Professor Shuri just said, because when you have unilateral adjustments for transfer pricing purposes, you have to reflect these adjustments in the other entities unless you have a low tax jurisdiction from the last 2 years. I think the rule is like that.
Yeah, there was one rule specifically about the different levels of taxation between
Yeah.
two countries. Yeah.
Yeah, when you have a
But I think
unilateral adjustment.
Yeah, thank you. Very, very, very good. Well, I think the commentary. No, Gabriel, sorry.
One question: this arm's length should apply even for operations within two companies in the same country.
No.
Gabriel, from what I understand, since this is a jurisdictional approach, it is irrelevant because you are going to add up all of the revenues. You're going to add, you can.
Rules that hamper you for doing abusive tax planning with a location between two entities in the same jurisdiction. But it's not full transfer pricing. It's just some targeted rules that hamper you. I don't remember them by heart. Maybe you do, but it's not full transfer pricing. You just have anti-abuse rules.
Sound. Oops. It's it is created for avoid the abuse. It's not exactly the transfer price in the same jurisdiction, but the point that Professor Shwedi said is super relevant. It's with the idea that the pillar 2 will assess the whole thing with a separate entity approach. You will consider the separate entity approach in the transfer price. It's not, we were not overcoming this assumption. We are continuing seeing the companies separate. The point that Mariana said, it's important because there are some comments about in commentaries about this situation here. And I think they were thinking about that one jurisdiction under the Pillar 2 rules and another jurisdiction out of the Pillar 2 rules. And this problem, I don't know. I don't know exactly. There is no example of, about this, but the idea that there are two jurisdictions, one of them without the Pillar 2. And what is the consequence? And the consequence you have to create this kind of adjustment. But if you had two jurisdictions under the Pillar 2, I think that problem doesn't exist. The fourth one is qualified refundable tax credit. I will put just one comment here because you have class tomorrow, and the idea that you use this on accrual basis. This is important for us here. The doubt was raised here. Oh, I will have that credit in the future. I will recognize in a cash basis or accrual basis. The answer here is accrual basis. That relevant here for us. And the comments and details about the qualified refundable tax we'll see tomorrow. The fifth one is regarding the method of recognition, the realization or fair value. And there is an option, an action according to which during the 5 year, and you have to use the 5 year for whole jurisdiction. It's a jurisdictional blending as well. You can decide if you go to the method, a realization method or value method, and this helps in general to minimize impacts of assets volatility. And it's important for companies, for example, the agribusiness companies, super relevant. I'm seeing this thing now, and I think that the option will be selected for many companies thinking about the facility to assess, because the other hand use the annual basis and much more is harder to assess. The sixth one is the idea of spreading capital gains and another election. You can election another 5 year period to recognition the capital gain and mitigate the impacts of one single year, and it's super relevant for immovable property in one jurisdiction. It's another relevant election. In the fifth one, we're finishing this, and that the seventh one is the intra-group financial arrangement. That's something that we're talking about, and the mechanisms here is you when you have a deduction in a low tax jurisdiction without a corresponding inclusion in a taxable income high tax jurisdiction, you have necessarily adjustment to achieve the level of taxation, because this hybrid mismatch will be eliminated in the pillar 2. That's the main idea. The intragroup the rule says that the computation of the low tax entity global income or loss shall exclude any expense attributable to an intragroup financial arrangement that can reasonably be anticipated over the expected duration of the arrangement to increase the amount in expense taken into account in calculation of global or loss without resulting in a commensurate is a trick word. It's a proportional. It's easier to understand that commensurate increase in the taxable income high tax counterpart.
Something difficult here. What is low tax jurisdiction? Because you will only know whether it is a low, for purpose of globe, you will only know this with the ETR. And for the ETR, for you to calculate the ETR, you need to know the global income. So it's kind of circular here. I really, it's very difficult to apply this. I mean, in a concrete case.
Yeah, I don't remember if the definition of the low tax jurisdiction. I think it's not a Mariana knows. Please.
Sorry, but I think that for that article specifically, you have a definition of low tax jurisdiction that does not consider the intragroup financing arrangements. So you do not consider that, and you come to the ETR, and then later you do the intragroup financing arrangements calculation.
But the threshold is 15%.
Yeah.
Okay. Before ETR is not individual. It's okay. Thank you. So if the example of this is exactly like this, I should study more. If the constituent entity is located in a jurisdiction with the ETR with the last 15%, the ETR can be increased by granting a loan to that entity. So the ETR of the low tax entity would increase the interest expenses will be recognized in the financial account, but not in the tax account. So it's a very interesting, I think it's very common to this kind of arrangement, intragroup arrangements, and M&Es in general. But I am feeling in reading the comments that there are a lack of examples. I think it's a poor description, this part, specifically this part here.
For us to be all together here, just to think together. The more I have as an interest expense, the lower is my income. The lower is my income, the higher is the ETR. So it would be a tax planning to increase my interest in order to reduce my globe income, in order to increase my ETR. And this is what they are avoiding here. Because otherwise you must, sorry, I'm slow. I like to think and understand the logic. Then it helps a lot.
Perfect. Gabriel.
Regarding the fair value, so it's preferable not to include the revenue related to the fair value here in Brazil, because you don't tax this if you put this amount in subconta.
Yeah, you
So it's
defer.
better. It's preferable to not include this income in your basis, because you're not taxed. And another point is that,
Yeah.
should I consider the deferred tax liability regarding these payments of the fair value in the future?
No, at the same
Now,
moment.
even if I don't include, I don't know if I'm clear. I not include the fair value in my my global profit. I choose that because I have this election, but I have a deferred tax liability regarding this fair value because I'll be taxed in the future. Should I include this deferred tax liability in my covered tax?
It's a part of Gustavo.
Gustavo is going to explain, but from what I think, and it's always the same, they have this idea of matching. So always the question is, whenever you include an income, you include a tax on this income. So to answer you, if you're not including this amount, so the deferred tax which refers to this amount shall also not be included yet. Think on matching; it helps a lot.
The question is, when you're deferring the recognition of income or something or loss, you're deferring as well the the related tax. So you create a match in the future. It's not a possibility to separate in at different moments the recognition of tax or income.
Wait, but deferred tax, you recognize the income, but you don't pay. It's something different. The income is already recognized. It's not deferred. The income is there and your liability is there. And then you recognize the tax expense and the liability of the deferred tax liability. If the income is not even recognized, you don't have a deferred tax liability. So
Mentioning the case of fair value in which you would, for purpose of balance sheet, maybe you would recognize it, but and then you would, but you would not tax it immediately, so would have a deferred tax.
if it's included in Globe, then you have a deferred tax and it'll be within the adjusted cover tax. If it's not included in Globe income, then the deferred tax is also not an adjusted cover tax.
Once again, matching. If you think on matching, it helps a lot.
Yeah, and there's some comments here. It's interesting because before the Pillar 2, the main concern was about the differences in treatment of tax purposes. And now, after the Pillar 2, you have another chapter of this. Because if you have the differences in the accounting treatment, it will impact the tax treatment. So there are two parts of this kind of mismatch. So it's another chapter of hybrids. The consolidation, then number 8, it's possible to elect another important election. Here you can decide to consolidate in the same jurisdiction whole parts of the M&E. We don't have this in Brazil yet. But it's impossible in the Pillar 2, and you cover everything: income, expenses, gain, losses.
When I mentioned, Gustavo, you made some face to not to agree. That's why I'm going to confirm whether I'm wrong. Please, and please tell me if I'm wrong. Within the same jurisdiction, whatever happens, because of the jurisdictional blending, you have to add all of the incomes and losses all together and the taxes all together. That means whether you are consolidating or not would bring exactly the same result. Or are there exceptions which I have not seen?
There are exceptions, and if you want, I can find them.
Okay, so I want you to find it because I
You're gonna cover this now? No, no. Go ahead. Go ahead. Okay, perfect. So, great question. And the number 9 is now we're going deep in specifically sectors. We have a adjustment specifically for the insurance company, and because they have some values paid to policyholders, and there are some insurance companies that wants to exclude the this amount in the computation of the global income, and there are specifically provision allowing this kind of exclusion. So it's super specific. So we can not cover in detail here. Another sorry, microphone. You're covered in insurance company. Yeah. She works with the insurance company.
I think because a provision here is like a technical provision considering like the probability in the future you have like the risky happen. So I think it's in Portuguese we say reserva técnica. It's not like a different nature of provision. It's not like it's
It's a
actually
kind
a
of
liability already.
it's a kind of mandatory debt to avoid the lack of resources in the future, and it creates some temporary differences. The next one is exactly the same, because the additional tier 1 capital, I didn't know exactly this concept. I learned from pillar 2, so my lack of knowledge about the financial sector, but it's a kind of, if I understood, it's a kind of deposit or something that you create as separate equity inside of the financial institute.
Can I?
Yeah, please.
It's for example, in Brazil, it's a letra financeira subordinada. It's a kind of liability of the company, but they are just one layer before the equity. So it's almost equity, and the investors already know that in the case of bankrupting of the company, they are not they are really in above to take the amount in a bag. So because of this, when we are making the calculation of the Basel limited, and a part of for example, for each amounting of capital, you have the right of an issue on the tier 1 capital. I think it is 20% in Brazil of the capital, and you can consider it as a capital. So we have the equity, and we have like the a complementary capital that is calculated based on tier 1, although it's a liability for the accounting perspective.
Oh, thank you. According to commentaries, there is a example in which I think I understood that it's a separate equity based on a mandatory rule. So you have to protect the equity of the entity, or to create a separate entity, and this equity can increase or decrease, creating a profit or loss. So you have to treat it an expense or a profit according to the amount, the process of recognition of this amount. So you will treat this kind of equity as a separate entity in terms of financial recognition. So you can recognize expenses or a profit from this. At the moment of this, it happens.
Just to give the answer here, which Gustavo was presenting here, and just for us to have the same page, it is possible manipulation if you consider stocks. That means I can have a loss. I have in my side, and you may have the your gain was not realized yet because it's in your stock. So I can anticipate a loss in one company, which will not immediately correspond to a gain in the other company because the amount is still in the stock. So yes, this exceptional situation, you can say that transfer pricing within the country would be necessary to avoid this kind of manipulation, which is the stocks manipulation. Is this clear? Are we talking the same page?
Great. The last one is the catch-all article is the further adjustments, and it refers to chapter 6, the corporate structure and holding structures, and the chapter 7, tax neutrality and redistribution regimes. And that was the article 3.2, the 11 adjustments. So a little bit boring going to the wording. It's super, reading whole commentaries, whole examples. I think the main idea that you have to sum up to a treatment that from the accounting source, it's not sufficient for the Pillar 2 purposes. You have to adapt IFRS because it's not necessary to create a kind of harmonization, specifically for temporary adjustments. I think it is the sum up to cover whole 11 adjustments. And to finish my part, I will put some comments on international ship income exclusion. So specifically thing, it's for shipping activity, you will not treat the shipping as a P. We will not treat as shipping as a different company or something like this. You will exclude everything related to this transportation of passengers, cargo, the whole thing in this kind of definition of 3.3.2. So the main entity will not recognize this ship as a separate part of the entity. To allocate the P, the article 3.4, that important part here, because it says the financial account net income or loss of a constituent entity that's a permanent establishment according to is the net income or loss reflected in separate financial accounts of the P. So the assumption here that P has its own financial account. If the P doesn't have the separate account, it will be treated according to the UP consolidate financial account. That's the catch-all rule, the last part of the article. But Professor Schwede would say something.
Say, P's are always a problem. Are always a problem because they are mere PE. They are a permanent establishment merely. But then you have this idea, this fiction of independence, which requires you to begin making believe. Make believe it is a company. Make believe it looks for profit. And it's because this is what you call in the international tax law the authorized OECD approach, which, as far as I'm not aware of many countries which have ever adopted this AOA. AOA is an idea of the OECD, but most countries are not adopting this in their treaties because it makes no sense. And suddenly you see the AOA here they are enforcing an AOA, which I don't know how they're going to do it. Because the OECD makes believe that everybody's adopting AOA. Obviously, they're adopting, but countries are not.
AOA under internal law?
Not, no, certainly not. No, AOA, no.
Anything on the product applied transfer pricing? What is AOA?
You treat as you don't follow the four ideas of transfer pricing in the because
Hi. I was going to ask about it because I know that in Brazil, in our tax treaties, we adopt the relevant business approach, which is more aligned with the UN tax model convention. So it's not a full AOA. And if I am right, I think we have never adopted the AOA because not even now we have like a provision or something in our domestic law that says that. So how are we dealing with the globe income when we have to provide some kind of profit allocation to PEs if in our tax treaties, for example, we follow the relevant business approach?
first, our legislation is very poor on what is PE, the concept of PE. You do have branch, but at least a branch, you know what it is, and you can even calculate something related to the branch. But when you talk about PE, it's much more than branch. And you don't, we don't have a legislation on PE. That's the reality. We don't have this in internal law. So Gustavo is saying no, but you have a legislation and you apply internally the AOA. Gustavo, get our legislation for commissioner. Has nothing to do with AOA, with this independent agent. Nothing to do with AOA. You only have something similar in the very specific case of a branch. But a branch, if you're going to create a branch, you must follow rules which will make that you'll have a separate capital. You declare the amount of the capital of the branch. You will register. So a branch, if you allow me to say, it is, I would dare to say, very similar to a subsidiary. That's why you don't have the problems which you would have. But the concept of the international concept of PE, service PE, you don't know how to do it. I mean, we don't have legislation for this. We and it's a pity. We should have, but we don't have.
And I think in our law regarding Pillar 2, or at least the QTMTT, they mentioned that the profit allocation should be in line with Article 7 of the OECD Model Convention. So are we supposed to treat Ps differently for TP and Pillar 2 purposes?
That's what I was mentioning, because not only the legislation, the OECD imagines that everybody is making this, because this is the model. The problem is that, once again, I'm not aware of many countries adopting AOA. Maybe they are, but I'm not aware. I mean, relevant countries which I've been following, they don't have in their treaties AOA. So the OECD is departing from, and yes, you're going to have different systems here, because here I'm not aware whether there were exceptions, whether countries were, when they were in the inclusive framework and discussing this, whether somebody says, hey, are you crazy? And I think nobody did, and now we may have a problem here.
Thank you.
So the goal of the tax policy here, or you can say the wishful thinking of the OECD, is to treat PE as a sub. Yeah, it's the same way to compute the ETR. I think that's, we can sum up with that. Maybe the last one I don't remember. The allocation of income or loss from the flow through entity, and deals with the idea of transparent entity. The rule said the financial account income or loss of the flow through entity is allocated to a P. Then a residual amount is allocated to direct owners. That it's important to, when you think that there are two ways to treat the flow through entity, you can see transparent entity or a reverse hybrid entity. And it's not exactly a common sense, the definition of hybrid entity, but it is a separate taxable person for income tax purpose. We don't have this exactly in Brazil, maybe a SPE, but it's not exactly a transparent. It's something that we don't have experience. So that's why it's hard to us the reverse hybrid entity. But the idea here is treat as a P or trying to identify a P to allocate income. If you don't identify a P, you have a residual approach, recognizing and the direct owner level. The 2 minutes, a glimpse of implementation in Brazil. I think it is a little bit out of the scope, but just to say a word of Brazil, I promise 30 seconds. Brazil has a very clear Brazil in our law created a super slightly deviation because the OECD says, oh, you have to use the IFRS, and Brazil said, no, you can use the legislation created by Brazilian standardizing bodies. It's the same, almost the same, because our CPC indicates the IFRS standard, but at the same time, our Brazilian body recognize for some sectors, as I said, allowed differences, energy, bank, or different areas, or even for companies in the under the CVM. When we said we have this super slightly different, but I think it can be relevant for some companies. And the last one is this deviation from Brazilian perspective. I think it is the Article 16 that created a concept of globe net loss that is calculated considering the delta between the adjusted cover tax that Gustavo will treat about this thing here compared to the less than 15% of the global losses. The catch-all here, the idea is that's my concern. I read in the one article. Oops, stopped here. I don't know. The article of the Lucas Carvalho. He wrote this article treating about this income, the globe income, and saying that we have here a deviation from the OECD recommendation because it is possible to cover to charge the CSL additional in the situation there is no any income because we have the only loss. Yeah. No, this delta is not under the model rule. The commentary is the 4.1, but it's not at the delta. It's you stopped when you according to the commentaries you stopped until the zero, no below the zero. In Brazil,
correct me if I'm wrong, but it generates additional top-up. You can make an election to defer, but otherwise you have additional top-up tax in the year, right?
you can defer, but according to the Article 16, it's not possible to defer. That's the part. Yeah, yeah.
I think Article 16 does provide a deferral. So
Polizelli?
yeah,
Vitor, I'm failing to see the difference between what the model rules and the commentaries foresee and our law foresee. Do you?
yeah, like Article 16, the negative excess tax allows a deferral. That's Article 16, paragraph 1. It's it's been there all along the provisional measure. Maybe Lucas was reading the commentary. I don't know when this article was written, but this procedure for deferral was created along the way. It's part of the commentary version 2, but was not there. It's not part of the model rules. It's part of the commentaries.
Mhm.
So maybe he was looking at something that wasn't there at the time of writing. But now, precisely right now, there is a procedure for deferral.
And Victor, if you don't defer, you have additional top-up tax, same as internal law and model.
Right away,
right?
yeah, right away.
Yeah. Because it's a, and I'll go into that in a second, but it's a not a temporal difference. It's a regular difference buried into a loss. And because it's buried into a loss, then the loss will allow you more adjusted cover taxes than you should have later. And that's why you have to expunge it. Either you do it now or you do it later, but you need to expunge it.
So if the law provides a deferral, I think there is no more difference. Thank you, Polizelli. So that's all. I think I will have to thank Gustavo and Professor Schueri. Oh, timely. I promised to cover everything in 1 hour and a half. So I will stay here with to learn from the second part. Thank you very much.
Thank you very much. It was great, and it was just the beginning. We still have a lot of ground to cover, but let's make a 5-minute break so I can start up the presentation, and you can go to the bathroom, and then we come back at exactly 18:40. All right? Thank you. All right. So let's begin. We went through chapter 3, and now we're going to chapter 4. So chapter 3, computation of global income and loss, and chapter 4, computation of adjusted cover taxes. So what do we do here? Basically, if we follow the OECD step-by-step approach, we first identify the cover taxes, then we adjust the cover taxes for temporary differences. Yeah, that's a breeze. And then we allocate the cover taxes between constituent entities, and especially we're going to see the CFC push down and the whole thing. And then we take post-filing adjustments into account if necessary. So what we're going to find here is that first box in green there, which is the adjusted cover taxes, which is the numerator that you put against the global income to find the effective tax rate. And then you apply to calculate the top up. So 15% minus effective tax rate. And then the old formula that we know about. So the jurisdictional top up minus the top up tax on excess profits, which you're going to see on Thursday. So you discount the SPIE. And then you discount the QDMTT. So we're going to work on that little green box over there. And when we talk about adjusted cover taxes, we need to take 2 steps back and start with taxes. And then we go to cover taxes. And then we go to adjusted cover taxes. And then we go to the allocation of the adjusted cover taxes between the constituent entities. Taxes basically are defined generally as compulsory and requited payments to the general government. So they are compulsory and they are not reciprocal. You're not acquiring a service, you're not acquiring a good, so you're basically paying a tax. And then from taxes, we go to cover taxes. And then cover taxes, we need to explore a little bit more the definition of what is a cover tax. But it's not a cover tax that you take to the computation. It's an adjusted cover tax. And what do? You take the cover taxes and you adjust for the differences, temporal differences. You exclude taxes that are not related to global income. And you do a lot of other stuff that we're going to go into point by point. And then you allocate. So Here, just for an agenda, we'll start with the notion of cover taxes. This is not in the order of the globe rules because the globe rules start with the adjusted cover taxes and then it goes to the cover taxes, which is weird. They didn't want to put the definition first, but it makes much more sense for us to start with the cover taxes. Then we see the adjustments to get to the adjusted cover taxes. Then we go to the allocation, and then we deal with specific provisions to deal with temporary differences. We could do allocation later, but allocation is not as hard as the temporary differences. So we do allocation first. We figure out the whole CFC push down, which is the main thing that we're going to see on allocation. And then we go into the hard stuff, which is the deferred tax liabilities and the deferred tax assets. And then we finally deal with the post-filing adjustments. If we have time today, probably not. We'll do it tomorrow. Okay. So the notion of covered taxes, it seems pretty straightforward first, but there are some issues here that I would like to highlight. The first one, so you basically have 4 items. The first one is taxes recorded in the financial accounts, and it doesn't differentiate current from deferred. The differentiation from current and deferred is going to come later in the adjustment covered taxes. So adjusted covered taxes are current taxes, but then it puts the deferred into the adjusted covered taxes by means of a different mechanism. But here, taxes in general, so the covered taxes, which should be income taxes, are basically taxes recorded in the financial accounts of a CE in respect to his income or profit. So a general definition, Leonardo was talking about the definition of an income tax. I'm not going to go back into the specifics that he went into, but I will raise 2 issues that might be relevant here. And then there are some specific cases that the definition of covered taxes already takes care of. The first one is eligible distribution tax systems, which are grandfather tax systems that tax only upon distribution, the corporate income tax, but only when they're distributed. This is not relevant for us here. Then you have taxes imposed in lieu of a general applicable corporate income tax. And that one is relevant, especially as I'm going to show you in a bit, to deal with presumptive systems. And our presumptive system, in my view, the only way that it fits into the thing is because of item 3 there. If not, probably our presumptive system would not be considered an income tax for this purpose. Presumptive tax system. But it does, but only because you have this escape clause. And finally, it goes even further to define taxes on corporate equity, which is not an income tax first. So it's a tax on net equity. It might work as a backstop to the income tax, but it's not income tax per se, but it's there. And tax on multiple components based on income and equity, which means basically withholding tax of different sources on components of your income would also fall within the definition. Yeah, Shweta.
In your opinion, PIS and COFINS would enter here or not? Why?
No, it wouldn't. Well, there's an easy answer, and then there's a more complicated answer. The easy answer, well, this is a closed system. If you take into account that the model rules and the commentaries make up the system, it's expressly provided that PIS and COFINS wouldn't be there because VATs aren't there and turnover taxes aren't there. So that's the easy answer. It's within the law, as to say. The not so easy answer, I'll get into a bit. And let's get into it now. So would the definition, and that will prepare for the second question, would the definition of income taxes that we saw there include, for example, what Trump almost did or tried to did, especially Paul Ryan tried to did in his first term, and this is an academic project that comes from the early 60s in the US. So a destination-based cash flow tax. So basically, you tax receipts, but you deduct expenses. You expense the acquisition of fixed assets. So instead of depreciating, oh yeah, everybody tries to do it. So instead of depreciating, you expense in the first year, and then you can go even further and do it destination based, which means that as a consumption tax, you tax what is consumed here, but what is produced here and consumed elsewhere, you don't tax. You do this with a VAT by allowing for the refundable credit when you export and taxing the imports. You can do this with a cash flow tax just by means of not allowing a deduction for imports and not taxing income from exports. This wouldn't fly on the WTO. It's going to be considered a tax subsidy and a discriminatory deduction, but nobody cares about the WTO anymore, especially Trump. So he probably cared a little bit back then in 2017. Now he doesn't. But the thing is, a destination-based cash flow income tax is not an income tax at all economically. It's a consumption tax. Would it fall within the definition? Well, maybe, because when you go to the commentaries, well, there's no internationally agreed definition of income tax. Income tax is general levy on a flow of money or money is worth at accuracy to a taxpayer doing this is wrong during the time. Income taxes, I don't know. It probably something got messed up there. But basically, the commentary says that income taxes allow for deducting expenses that are used to produce that income flow. It doesn't say anything about depreciation or accelerated depreciation, super accelerated depreciation. And the commentaries are very lenient on allowing or not allowing for expenses. So you basically can do whatever you want under your law. So this could fly. And then one can say, well, that this is exactly as a VAT. The only difference is that this deducts as wages, and wages are taxed on the individuals, and VATs don't tax wages, and they don't deduct it. They don't give a credit for it. But VATs, and that's where I was going to get, are not allowed expressly under the commentary. So consumption taxes, such as sale taxes and VATs, are not allowed. Excise taxes, digital service taxes, stamp duties, payroll taxes, and property taxes. Those all are listed as non-allowed taxes by the commentaries. So, Shwedi?
I hope we are not going to have PIS and COFINS soon enough for us not to care about. But I would not immediately say that PIS and COFINS are a VAT. Not immediately. Because when you consider what you have in PIS and COFINS, you have, for instance, financial income. They are taxed. So I mean, it's a different basis. It. Thank goodness we're not going to have this monster anymore. But I can at least build a good argument to say, sorry, VAT is on sales, is on the operations of sales, is based on the sales. And PIS and COFINS are not on the sales, they are my revenues, which include several things altogether. You do not segregate one operation from the other. I mean, I have good arguments, at least, Gustavo, to say this will be the case. Thank goodness they will disappear soon enough for us not to care about this.
Gustavo, may
Yeah.
I,
Sure.
may
Go
I,
ahead.
on a very rare event, agree with Professor Schwedi here? Just on, I wouldn't say this is true for actual profit regime, but if you take the presumed profit regime, which may be an issue, then you are talking about fiscal fees being levied exactly on the same
Well, but
tax
it's
base,
different.
except for the presumption.
It's different. It's different for the presumptive taxes because, as I'm going to show you, they are only allowed because they are charged in lieu of the regular income tax. PIS and COFINS are not charged in lieu of the regular income tax. They are charged on top of the regular income tax. So what the commentaries do is that they disallow taxes on gross revenues unless they are some way to reach income in lieu of the income tax, in place of the income tax. So it's a construction, but that's how it's done. But Shwedi, I agree that PIS and COFINS, and for some of your reasons, but mostly if you think economically, what all the economists say, well, if you have a VAT that don't allow for a full credit on fixed assets in the first year, you depreciate the credit. Those are not consumption taxes. Those are income taxes levied in a different fashion. That's what the economists say. So ICMS, our state level VAT, is not a consumption tax per se economically. It's an income tax because it depreciating 4 years the credit. So if you go to that reasoning, economically you're taxing income at some point because you're depreciating. But in the WTO, it never flew because the definition is direct and indirect taxes. And here it probably wouldn't fly either because the definition of income taxes takes into account that, well, you have a flow and then you have an expense. The credit system and the whole system of the VAT wouldn't fit here. So I wouldn't go as far as saying that we would have a case for saying that PIS and fees would be included. But you know,
very briefly, there was a similar discussion when the I can't remember the name of the equivalent rule for deferred taxes in IFRS terminology, but anyway, the IFRS that I think it's IAS 12 or anyway, the IFRS rules that deals with deferred taxes. There's a similar discussion there, and if I remember well, the YASB board or IFRS simply gave up on defining what is income tax or not, but it was also something to be thought about, and this discussion never ended there.
Mm-hmm.
For purpose of foreign tax credit, what I learned is that this is a political decision in the US, whether you grant or not, because there are taxes which are very similar, and from one country they grant credit, but the other not. So Vitor, don't call the US to say, well, there's a logic on this. This is political. And you say, okay, this is a grant, the other not. There was the issue of Bolivia. And
Bolivia was a cash flow tax. They did want to enact a cash flow tax, and the U.S. didn't allow because it wouldn't allow the foreign tax credit. And then you see a project in the U.S. to adopt the same thing. We had our issues with foreign tax credit and our withholding taxes and our sourcing rules, which are wrong, by the way. But anyway, but so that's the definition, like it or not. And then the presumptive system, our presumptive system, which is levied on gross revenues, and you presume the income applying a percentage upon gross revenues. Well, would that qualify? Because if it doesn't, if you have a Brazilian subsidiary of a UP, a foreign UP, then nothing that it has paid as income tax and CSL would qualify as a covered tax here, and then the ETR would be zero. Then there would be a real problem. Well, if you look at the commentaries and you go to what they say about deductions, they do say, well, you have some leeway on deductions, but you cannot simply tax gross revenues. So a tax imposed on gross income or revenue without any deductions would not be considered an income tax. That's the first thing that they say. You can have a standardized deduction in place of actual expenses, so that's one possible leeway. But then when you go to the commentaries of the in lieu of an income tax, then they are much more lenient. So they allow you to use an alternative basis. So taxes on the number of units produced, on commercial surface area, which are used as substitutes for generally applicable income tax. Well, if that is allowed, our presumed profit will probably be allowed too. So if a jurisdiction imposes a simplified methodology for calculating the income on a particular category of business or investment, and this tax is imposed in substitution for a generally applicable income tax, then it falls within the definition of a covered tax. There you go. I think this completely solves the issue for us, and we can consider, even under our presumptive system, our income tax and CSL as cover taxes. The second thing is our withholding taxes on distributions. deemed as covered taxes. And I know some of you guys have already faced this discussion regarding our interest on equity, juros sobre capital próprio. So this involves allocation. This involves a lot of things that we're still gonna see, but I put it here because the issue do refer also to a definition issue. So taxes on distributions. If you have a pure distribution regime, those ones that I said that were grandfathered, that the corporate income tax is not levied, you levy the corporate income tax when you distribute, then it's deemed as a tax of the constituent entity that is distributing. However, this is not the case. We're talking here about a tax on dividends distributed or a tax on a dividend that is treated as interest, such as our interest on equity. Then is it a covered tax? Yes. But whose covered tax? The recipient's covered tax, not the payor covered tax. So if I'm distributing a dividend, initially that tax is of the UPE that is getting the dividend. Under the allocation article, you reallocate that to the payor. You reallocate that to the constituent entity that is distributing the dividend. But in principle, that tax is a tax of the person receiving the dividend because it's an income tax of that person. And this is relevant, and I'll show you why.
It's a good question because it's a question because I don't know the answer really. Once you allocate, so it's not that a tax of the parent, it's a tax of the subsidiary, okay? However, when the parent would be subject to a taxation, let's say of 20% in its jurisdiction, due to the credit, it pays only 5%. Not because the jurisdiction is a low tax jurisdiction, but because of the credit method. That means you might penalize the the parent jurisdiction, which let's say it would tax on the 30%. However, due to the credit, it would tax only the remaining 5 or 10%. And for computing the ETR of the parent, what would you consider, the 30, which would be the original tax, or the 10? If you consider the 30, then you're considering the same tax twice because you have already allocated, to the subsidiary, you just said. So please explain. Sorry, is the question clear? Good.
We can go further into that later, but you allocate it to the subsidiary in order to forget QDMTT. Let's live in a non-QDMTT world. So you're dealing with IRR. You allocate it to the subsidiary to calculate their effective tax rate. If the only thing that's going to tax that income on the UPE's country is the IRR, then there's no issue at all because you take away the QDMTT from the IRR. If you're dealing with CFC taxation on top of an IRR,
assuming 2 tiers, I mean, assuming several of them, I mean, because you have the UPE, but you may have the subsidiary in country F, then you have in country E. Country E is not in UPE, country E is country E. Country E taxes on a 30% basis. However, it will not charge the 30 because there's a credit of 20, which is allocated to country F. So country E shall be penalized because it didn't charge due to the credit method.
Really, the intermediary country that is taxing is not taxing by IRR, so the allocation is irrelevant. The allocation only matters for Globe. It doesn't matter for another tax on whatever. If the person that is paying the IRR is the final country of the UPE, that's where the discussion is. It's not elsewhere.
Or to agree with you, no. But you've got also, imagine that there is no IIR there, but you have the UTPR, and UTPR will consider every jurisdiction. So the jurisdiction E will be considered as a jurisdiction E. Or am I wrong?
But the UTPR will be allocated to the jurisdictions according to the UTPR rule, but the UTPR calculation will take into account the same thing as the IRR would. It's allocated to the entity, and then you don't have an IRR on the difference. The foreign tax credit is irrelevant here. I will draw you an example, and we can go through it tomorrow. I think it's easier because I don't think I have a three jurisdiction example here, but it works, and I'll show you. All right. So what we need to so as I was saying, if you have a tax on the dividend distributed, it's attributable to the UPE receiving a dividend, but then you can reallocate to the entity that is paying to calculate the RQD-MTT or the IRR on the profits of that jurisdiction. What if I have a distribution that on the corporate side is a dividend, but you treat it as something else for tax purposes, just like we do in our juros sobre capital próprio. And basically the commenters say, well, the distribution has to be on equity, but it doesn't matter if it's not qualified as a dividend for tax purposes. It can qualify as something else. But if it's made in respect to ownership interest in a constituent entity, and under the financial standard of the EP is classified as a dividend, then it is a dividend. And then you can use the tax as a covered tax, and you can allocate to the constituent entity. So our juros sobre capital próprio, our interest on equity, which is a dividend, treated as an interest for tax purposes, which is deductible and then taxable as source, it is within the scope. So the withholding tax that we charge is within the scope. That's the first thing. But then comes the hard part. One, you need to figure if this is a disqualified refundable imputation tax, because if it is, then it's not a covered tax. And if you have, so the point is, if you have an imputation system, meaning that dividends are taxed, but then, so you have a withholding tax on the dividend, but then you have an imputation credit on the person receiving the dividend. That can make the tax that you charge the source completely go away through an imputation credit. Imputation credits are fine, but they have to pass certain tests to be a qualified refundable imputation tax. So basically, if the beneficial owner of the dividend is subject to a tax at a nominal rate that equals or exceeds 15%, you're fine, even if you give an imputation credit. Well, that is the case when a recipient of juros sobre capital próprio is for example, a corporation in Brazil, and they have an imputation credit, and then basically they are taxed at 34%. So we're fine here. The second question would be, how do we allocate? And let's go to an example because it makes life a little bit easier. Let's say that I have Biarco in RAN, in the end there, and it has book profits of 100. It's paying interest on equity of 400. So its taxable profits would be 600. 34% corporate income tax, so 204 corporate income tax. And you have a net of, if you consider this dividend, then it would be 1,000 minus the corporate income tax, 204. It'll be 796. That's the net income. What is the ETR of this entity? Well, if you don't compute the withholding tax on the interest on equity paid, the ETR is 20.4. You're still fine. There will be no top up. But, you know, jurisdictional blending, you might have another entity that is not in such a good place. So it's important to know if the withholding tax would be added to the covered taxes here. If all withholding tax on this interest on equity that we tax at 15% as source is computed, then our covered taxes would go to 264, which is the 204 of corporate income tax, plus 15% on the 400 paid as juros sobre capital próprio. And there's a third alternative, which is the withholding tax would only partially be considered a covered tax, which is what it seems that our law, which is very convoluted, but it seems that that's the approach they are taking. And what exactly would be included? Only the withholding tax of the UP. Because remember, this is a covered tax of the UPE, which is then allocated to the CE here to calculate QDMTT and to calculate the IRR over that jurisdiction. But it's in principle a covered tax of the UP. So the other recipients of the Juro sobre Capital Próprio are, in my example, a Brazilian individual and a Brazilian corporation. We don't have an imputation problem because both of them either is going to be tax exclusively as source or the other is going to have a credit, but the tax rate is much higher than 15%. So we're fine. It's not an imputation problem. It's a problem that those are not covered taxes because the only covered taxes is the one of the UPE, which you're reallocating to the Brazilian constituent entity. So what our regulations say is that you will be allowed to take the corporate income tax 204 plus the withholding tax on that remittance, which is 54. So you would have 258 of covered taxes here, and not more than that. You need to throw away the rest of the withholding tax. And although that makes sense, there is a problem here because this is a rule that was developed when you're dealing only with IRR. And IRR is going to tax only the 90% of the profits of the Brazilian corporation because that's how IRR works. The problem here is that we're taxing a QDMTT. And unfortunately, as Ricardo was saying a couple of lessons ago, the QDMTT doesn't tax only the proportion of the Brazilian company's profit that would be included in the IRR. It taxes the whole thing. And if it taxes the whole thing, it would surely make sense for the withholding tax on the whole interest on equity payment be included. But, that's a deficiency that is under the core of the QDMTT. And the problem is that unless the commentaries are altered, you don't even need to change the model rules. You need an AG or a change in the commentary of some sort. But unless those are altered, I don't know if there's much that our internal law can do. Otherwise, they will lose the qualification. That's the issue that you're probably facing here. Yes, who?
No, I was just pointing out, maybe I'm wrong, but I don't think that the law provides for the same limitation that the normative ruling provides.
Well, I think you're correct, Paula, but
Yeah.
they gave
I'm
up on
I'm
legality
just
a while ago. So,
I no, I'm not going philosophical there. If you're thinking about strategy, this would be a good point to discuss because yes, well, it's logical and it's fair to consider those withholding. The law does not prevent it, and the only limitation is in a normative ruling. So I'm just pointing that out. That again.
yeah.
It makes sense. And the commentaries, they are in no way binding to us. So that's interesting, but at the same time, it's kind of.
What do you mean they're in no way binding?
I mean,
They're not binding to the taxpayer. I kind of agree on that. But, the problem is if you reach a point where your challenge of the rules takes away the Q from the QDMTT that you got, you're probably on a bad place because you're going to lose the safe harbor and you're going to lose the formula for calculation. So for this company, if the UP country, which I chose, I don't know, Germany, if it has an IRR, I would think twice before challenging this thing because although you might say, well, the commentary is not binding, if this is part of the system, and I think it is, because the system was taught this way with the RR in mind, if you challenge that, you might be in a bad place within your group that your QDMTT will serve a lesser purpose that it would if it was qualified. So that's one thing. However, if I was this other guy, for example, a Brazilian corporation with a foreign sub that, let's say, has Brazilian shareholders. It's a public corporation, some individuals, even some corporations, we don't care, but only Brazilian shareholders. And then I'm subject to the QDMTT. I don't really care about IRR because I don't have a foreign UPE. I'm subject to a QDMTT who God knows why, because this is a situation that shouldn't be. Huh? Biarco. Yeah. No, they're here.
They are that person.
No, but
Yeah.
I don't care, but it's subject to a QDMTT. Yeah. 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 Because he went abroad. That's the idiotic part of the rules. That's the really idiotic part of the rules, because nobody should care about that unless you say a floor to tax competition is even relevant in this case. Because this is a multinational and this company has operational income and it's being under tax and you want to police that also. But that is far-fetched. But that's how the rules work. But this one, I would challenge the hell out of it because I have nothing to lose.
Yeah, this situation it's very complicated for the companies that the UPI is a Brazilian company because we already suffer with the CFC rules, and so when you don't have like an operation abroad, like the solution that the most part of the taxpayer here in this situation are analyzing, it's close the subsidiary. Yeah, it's real. It's not. I already listened in on all the presentation of the Big Four. This situation, it's like not unthinking when the Brazilian adopted the KDMTT, and but this is a really huge problem.
The thing is, if our QDMTT hasn't gone there, we'll probably lose the queue. So that was the issue. But yeah, it makes no sense whatsoever. And I mean, I would challenge this one for sure, in whatever ground legality and whatever you can find. And then, Paula, the normative ruling is not under the law. The law doesn't make that restriction, and so on and so forth. So I would definitely challenge it because then in this situation I don't have anything to lose. I don't care about an IRR. My QDMTT is not going to reflect in anything else. So, questions, Carlos?
Yeah.
Victor?
Can I say something?
Yes.
This is a very hard topic, and I was reviewing the rules here. So there's this idea that withholding tax should be attributed to the distributing entity, and that's sort of the general rule in Globe, and I don't think there's any way around that. So, like for this example, the withholding tax in Argentina, I can't remember the country below, but anyway, that would stay there, and there's nothing we can do against that in the Globe model rules, let's say. But the other example, this one here, so Article 47.5.
Which
was-
example are you talking about, Victor? This one that I'm projecting
This
now?
one
or
now,
the-
yeah. Yeah.
Okay.
The other
All
one,
right.
I would say the fact
Yep.
that the withholding tax in country sub
Mm-hmm.
belongs to country sub. That's part of the model. We can, as you said,
Okay.
if we can.
Let's go back to the
Listed, but-
first one. All right.
Yeah. So this one, yeah, 47.5. 47.5 is different in the Brazilian normative instruction as compared to the equivalent. And the equivalent is 432A, 432E. So in 432E, it says that the taxes paid by the investor, it doesn't have to be the UPE. It could be any investor. It could be the green investco here. So in the model rules, the taxes paid by that investor in relation to distributions could be dividends, right? But in our case, it's something else. So those taxes in the model rules, they belong to the distributing entity. So anytime you have dividend payments, the taxes, including like the IRPJ paid by the green BR investor here, would belong to the distributing entity. They're in the very same country. That wouldn't change much. But anyway, that's how the global model rules
But Vitor,
say.
you're
But in the
reading from
normative instruction, we
3.2e.
said, yeah, it would be always like the withholding tax or the corporate tax on dividends. They are pushed down to the distributing
Yeah,
entity.
but it has to be a cover tax accrued in the financial accounts of a constituent entity direct, which is a direct owner of the other one. So it needs to be a cover tax, and it needs to be accrued in the financial account of that entity. So if you don't have a constituent entity that is accruing that tax on their financial account and it's deemed a cover taxes, you're not within E, and you don't have anything to allocate. The cover taxes test comes before.
Yeah, I was worried with the fact that corporate, like corporations pay corporate tax in Brazil on JCP. They pay 34%, and that. So I'm talking about that part. So the 34% should be allocated to the distributing entity according to the global model rules, but the normative instructions say that these taxes belong to the owner, to the, how they call it, the ownership entity. And anyway, but then our rules are different in this point. Item 5 of Article 47 is different from the model. When the model say allocate to the distributing entity, we say don't allocate. Just say don't consider that. But then comes paragraph 2 and paragraph 3 of Article 47, and these paragraphs are not no part of the global model rules. They are Brazilian innovations. They were designed because of our peculiarities, let's say. And then they only talk about the JCP. They say that withholding income tax, in this case, will be allocated to the distributing entity. Maybe they were trying to make a special rule for our, characteristics of the Brazilian system, and in the end, they confirmed that the distributing entity can keep the withholding tax, but it doesn't seem to be something restricted to a UPE. It could be any shareholding, direct shareholder.
You might have a point there. You might be able to use that. I'm not sure, and probably nobody is. I don't know if the intent of the rulings or the regulations were to do this exact restriction. It's weird, but if you can follow up at that, the model rules don't restrict in that way, which so not sure. At least you open an interpretation of our internal rules saying that, well, it is allowed for you to be more permissive even without destroying the QDMTT. So yeah, there might be a way. All right, let's move forward.
Can I make a question,
yes.
Gustavo?
Who is it?
Can you go, Felipe?
Yes, Felipe.
Can you go back one slide?
This one?
This situation there.
Yeah.
Yes. I'm still wondering why in that situation we apply the QMDTT. Is that in the model rules or the Brazilian legislation?
You and
because
me.
If the
no, I think it's in both of them.
Okay, but if the QMDTT is to allow the source country to tax something before the home country tax it, and it was reached as a compromise in the discussions, what is the rationale for that? I still don't get it. Is there a justification or a rationale for that?
I don't see it, but the point would be that, well, this has always been a situation that was covered, and they didn't change
Because
it. I don't see a rationale. I really don't.
because here you don't have a home country
Yeah,
taxing if you don't tax,
yeah,
right?
yeah. I agree. I
But
fully agree.
Gustavo, isn't it to ensure floor of competition between the companies as well? Because then you would have a situation in which foreign multinationals would be subject to a minimum 15%, while local multinationals would not be in the same,
Yeah, but then
let's say, economic universe in the same market. So I think, and this is why they force the qualified aspect to being attached, that it applies to everyone, because they don't want to put the countries that adopt an IRR in a lesser position in relation to those that do not. So this
well,
is all within the logic of the rules, that everybody's pushed to adopting the rules and setting a floor of 15% and et cetera, et cetera, et cetera.
but then they should have went full European, taxing non-multinationals the same way, right? And you adopt only the threshold of 750, and that's it. Because a fully local company would still be competing with foreign subsidiaries of foreign multinationals. So the cut that they adopted, that if you go internationally, then you're under the rules, even if you are the UP. That's something weird, in my view. But yeah, your reasoning is probably the reasoning, but I don't know. I have a hard time accepting that this is the right way to go.
No, I think it goes to the heart of jurisdictional blending and how the rules are taught. But the conception that if you're a multinational, you are in further advantage is because you get to displace your income throughout the globe. And this goes a bit against what Ricardo said and is his thesis, but it's a it's sort of a blend between tackling tax planning and tackling tax competition, because when you focus on multinational companies, you are focusing on the possibility of income being displaced. So if you have, for example, a fully local company does not have the opportunity to shift passive income abroad, for example, while a multinational could do that.
But
So I think this is
that's
the
not what we're
underlying
dealing with here.
conception.
That's not what we're dealing with here. We're definitely not dealing with shifting of passive income, right?
I'm just saying you have you can shift active income as well. You can provide services from abroad. You can transfer your IP and then use it a factorization company. So you have all sorts of strategies. So I think that's the concept. The concept is it applies to everyone that gets to act globally and use multiple jurisdictions, which is why they use jurisdictional blending instead of global blending.
Sure, sure. But in my foreign activity, I'm all for having. Well, I'm all for is a bit too strong, but okay, I accept the fact that I might have a 15% floor, but for my local activity, I don't know. It's a little bit. If nobody else is gonna care about it, if I'm the home state of the capital, but yeah, it might be viewed as something else. Anyway, let's try to move a little bit forward and advance to, now we're seeing what cover taxes are. Let's go to the adjusted cover taxes. How a cover tax becomes an adjusted cover tax. What kind of adjustment? So then when you go to the definition of the adjusted cover tax, then the first thing that we notice is that it only refers to the current tax expense on the main rule at the head of the article. So it's the current tax expense adjusted by, and then you have additions, reductions, and a thing that is called a total deferred tax adjustment amount. So the deferred taxes are computed as a whole and then brought to the adjusted for the adjusted cover taxes as a whole, and we're gonna see how that works either today or tomorrow. Yeah, the net. Well, Well, if it's a tax revenue, the net it's more than an expense. You don't bring it because you only bring expenses. Although the deferred tax asset will have an effect later, but you won't pay that. You won't play a globe top up just because you have a loss, unless you have an ente, which you're going to see later. But if the net is a deferred tax liability, then you bring it into the game. But it's capped, and I'm going to show you in a second. So it's current tax expense, but it's also deferred tax expense. But the deferred tax expense gets a different treatment. You need to adapt it, adjust it, and work on it first, and then you bring it to the adjusted covered taxes. Current taxes are current taxes. There you go. But they are still subject to additions and reductions that we're going to see in a second. And they might also, let me show you an example, it's easier. What is an addition? Let's see here. So one addition that you have to do is that if you have a cover tax, which falls upon the definition of cover tax, but is accrued as an expense before taxation on the financial accounts. So an example, I have a company, here's the profit and loss statements. I have a corporate income tax there in the end. But before that, I have an equity tax that I don't charge here on my profit and losses as a corporate income tax expense. So it's not under the definition of the head, which is a current tax expense. It's not a current tax expense because it's not corporate income tax, but it's a covered taxes. The same thing with withholding tax in some interest income that I received, and I don't have a credit for the income tax, so it's just an expense. It's not corporate income tax. I can use both of them to compute the adjusted covered taxes. So I get the 3,000 of corporate income tax plus the 6,000 of equity tax and the 1,000 withholding tax. And then I'll have 10,000 adjusted covered taxes. And my net income before taxes is 30,000, so I'll have a 33.3 something.
I have a doubt, because like the most part of the accountants, when we have like a withholding tax, we classify it as like, for example, not just during the period is like an asset, but when I make the compensation, I reclassify as like an income tax on the on like the CTA, like on the when I the 3,000 probably, yeah, the
compensation is the operative word. The compensation is the operative word. If you can't compensate it against the corporate income tax, you treat it as an asset. And then when you compensate, it's part of the corporate income tax. So the expenses for the corporate income tax only. But if you cannot compensate it, if it's not credible, then it's an expense in itself. All right?
Assume you have a participation exemption, for instance. So that means you don't tax the income. So there's nothing to compensate. So in this case, it's a pure expense.
And even in cases that you have withholding at source, but it doesn't compute to whatever income you got. So then it's an expense, a pure expense related to the income that you got, but it's still a cover tax because it's a withholding tax and it falls within the definition. So you can bring it to the adjusted cover tax, even though it's not on a current tax expense.
But on your example, the CTI, the corporate income tax, like the 3,000, could have some withholding tax.
Oh, yeah. If it's withholding tax that you can't compensate, then it's a completely different rate, right? So that's the first addition that we saw there. So taxes that are accrued as expenses, which are not corporate income tax expense, but are still covered taxes. Any amount of globe loss deferred tax exit, which I will show you later how it works. The credits we'll discuss tomorrow, so this is out today. And any amount of corporate taxes paid in a fiscal year that relates to an uncertain tax position. And I'll get into that a little bit further because uncertain tax positions are not deemed as covered taxes. unless they are effectively paid, and you're not going to get it back. So that is a problem on its own. It's not even in certain tax positions that are computed as deferred corporate income tax, as it usually is. You cannot use it for the total deferred tax adjustment amount. It's out of there. So even if it's as a deferred tax, you have to take it out. And that is problematic, especially, as I was saying before, some classes ago, in a country like Brazil with a lot of litigation. And certain tax positions are basically everything that we do. So that is an issue. And we need to analyze that further.
But the uncertain tax position in Brazil, although the orientation of CPC are not really happen on the real life, I think it's very difficult to find an speculative note on the financial statements, and I read the list on that. Okay, we do not apply; it's just a kind of orientation, and our legal system do not require like it's the ambient the tax system in Brazil and the litigation here. It's make us not comparable with the uncertain tax position of the Europe countries.
I fully agree with you, but that's for purpose of IFRIC 23. That's for purpose of dealing it as a deferred tax liability or as a current tax liability. The problem is, even if you deal it as a current tax liability, what this thing is saying is that if it's in a certain tax position, you cannot take into account as a covered tax. And that is a huge issue, in my opinion. And the problem is that what is the threshold then if it's not of IFRIC 23? What do I use as an orientation? Like how much of a controversy do I have to take it out of my adjusted covered taxes? I don't have the answer to that one. I might have in the future.
According
Vitor.
to, yeah, let me make my line again. I said that last week. The uncertain tax position is different from uncertain tax treatment. So there's no direct reference to IFRIC 23. So and the commentary says that uncertain tax position happens when the tax authorities do not agree with the position. So it would be somewhat different.
But
Then
Vitor,
we have a problem, right?
for Vitor,
That's
for
different from
IFRIC,
tax treatment, yeah.
no, but for IFRIC 23, when we interpret that, because I think it's a very similar language, we always interpret this as being the ultimate decision level, which is the federal Supreme Court. I'm with Tati on this 100%. I don't see us having as much, although we litigate everything, we don't have as much as uncertain tax positions because tax authorities low level disagree.
I would love the words to be the same, but they are not. So this is uncertain tax position, and you're looking at the uncertain tax treatment. And
no, they are very
similar.
That,
yeah. But anyway, this is tricky, right? The normative instruction they made a lot of cosmetic corrections, and this was one of the corrections. So the former version, the first version said uncertain tax treatment. They really changed to uncertain tax position, which is to my view up to now a specific concept of Pillar 2 rules that do not necessarily coincide with the one
in
Vitor,
the IFRS. If it was the same over IFRIC 23, you wouldn't have a rule to deal with current taxes. You would only have a rule to deal with deferred taxes. Because if it's the same as IFRIC 23, it's always going to be a deferred tax liability. It's never going to be a current tax liability. Am I right?
Yeah.
So if you have a rule for current taxes and you have a rule for deferred taxes, they're basically saying that this is something else.
Yeah. Well, that's maybe my point too. I would be careful with this language.
All right, moving on. So you have the additions that we saw, and then you have the reductions to cover taxes. And what are the reductions? Well, first one, if a tax expense is registered, but with respect to income excluded from the computation of globe income. So I talked a little bit about this when you were giving our presentation. So, for example, I have a corporate income tax base of 100. I have a 10% corporate income tax, so 10 levied of corporate income tax, and I registered this as a current tax liability because I paid everything right now. But the problem is that for globe income purposes, only 60 is included, 40 is taken out. And so I have 6 corporate income tax related to the included part and 4 related to the non-included part. What you need to do is you need to take it out, the 4, and only 6 are going to be computed in your adjusted cover tax. Yeah, Shruti.
Question. But may you deduct this 4 as expense because you did pay for the purpose of the globe income? No, I agree. I mean, it's not the income is not the globe income, but the expense you did have, and so you're not crediting it, but you did have expense.
Look, you correct me if I'm wrong, but I think it's an expense attributable to income that is not included in the globe income. So I didn't look at the rules, but I would say that.
Let me give a nice example. We had Leonardo talking about the option to consolidate, right? 326 or something. So when you consolidate, you eliminate a lot of the income, and you also eliminate the taxes that go along with that.
Mhm.
So we were puzzled with the option to consolidate. Some of us might be thinking, well, why not, right? I should consolidate, then my taxable basis would be reduced. But then when you do that, when you use that option, you are giving away a lot of taxes. And of course, this option only makes sense in countries where you have a consolidated taxation. In Brazil, it wouldn't make any sense.
Vitor, I'm calling 2 or 3 slides ago, you had this this withholding tax, which was not, which is not possible to be offset. And you said, well, this is an expense anyway. We are exactly in the same situation. You have an income. We are exactly in the same situation. You have an income which is not taxable. So you may not credit the tax, but the tax did exist. It makes sense for me to deduct.
It's not the same situation.
It's a consistency adjustment. Yeah.
In the first case, the income was included on the global income. So the expense related to that income is deductible.
Discussed. Just remember, I mentioned, imagine you have participation exemption. This is the example I gave Tatiana. I said, I have a participation exemption. Yes. So I have a participation exemption. I do not include the dividend in my basis. So in the Globi income, I deduct from Globi the dividends, and but the expense related to it, I may deduct because the expense I did have. This was here.
I thought your example was that I have a participation exemption on my own corporate income tax system. I have a withholding tax on the dividends, and I don't. Yes, for abroad or locally, it doesn't matter. And then the withholding tax is going to be an expense, and then on the globe income, this is going to be a covered tax. However, just let me show you the example. If I have a dividend here that is not included on the globe income. So if you look at A Corp domestic taxable income, 100 dividend, 100 operating income. So total income 200, it paid 20%, so a tax of 40. On the globe income, the dividend is not included. The operating income is. So total globe income 100. How much of the 40 can you consider adjusted cover taxes? 20. And I wouldn't say that the other 20 is going to be taken away from my operating income because it's not an expense related to your operating income. It's an expense related to the dividend. And the dividend is not included. How can I allocate an expense completely related to an item of income that is not included to just offset other items of income. I need to look at the mother rules because I didn't go to the rules to see the situation, but I would, everything in me would say that you cannot allocate this income to the other, this expense to the other income. I'm not looking at the rules.
You will get lost. Yeah, you'll be lost. You'll be lost forever. You don't use that anywhere. That's right.
But there is another point because like the dividend income, it doesn't have any expense but that just the withholding tax, but the operating income, they probably have a lot of administrative operational expenses. So, when you are like, if you wanna be fair, you need to provide like an profit demonstration and make like the calculation again of the income of the income basis of like a demonstração por segmento.
Or you would need to prorate some common expenses because if you have an administrative expense that is both for the operational and both for the dividend, but then you're even more no, and then you're in a worse place.
This brings us to the question: what do Globe rules talk about this issue, which she correctly mentioned? Because consistency, I beg for consistency. If there are rules for this, I must follow you. But if they are silent, you are merely creating a rule partially. I understand your point, but what I'm saying is, what do Globe rules talk about this?
It's a chapter 3 issue. I'm not sure.
Yes, somebody here studied chapter 3 for a whole weekend.
I don't remember if it's
Vitor, I don't know if you saw anything on the commentaries of chapter 3 regarding this, or Vitor or anybody else here. I don't recall. I tried to look at expense allocation under this rule, but there's absolutely nothing there.
If it is silent, then your rule of allocation and so on, you're creating something. And you're creating, and Tatiana is correct, creating partially. Because it's either or. I mean, there are systems, and I'm talking about taxable income. If you go to Germany, for instance, I studied in Germany and I learned there. There you do have allocation. So in case the case you mentioned, you would say, well, part of my operational system are undeductible. We do not have this. So this is an option, it's an either or. In our system, if you have a holding company and it will have expenses, it will be deductible in our system. In Germany, you say, are you crazy? How can you deduct if you have no taxable income? So there are two systems. And my question is now, talking about Globi. If Globi is silent, okay, then decide it. But what you cannot do is what you did. I said, come on, the income tax, it is, you may not deduct. But the other, yes, you deduct 100%. This is inconsistent.
What I did was just, if you have an expense that is completely and exclusively related to an exempt item of income, then you allocate it there. If you have prorated expenses, then I don't see a prorated rule. So I wouldn't do it. Just one thing, in our system, we do have allocation on the tax incentive systems like lucro de exploração and something like that.
If I may just very quickly, the situation you described, Shwedi, if you have an expense in the accounting profit that doesn't belong to the holding company because of the German system, then it's a permanent difference. It's never going to be deductible for taxes, and it becomes a permanent difference. You should pay taxes right away for Globe purposes, depending on whether you have the negative tax situation.
Yeah, but the problem is that how does the Globe rules deal with expenses related to income not included in the Globe income? So if they demand, for
it's
example,
permanent difference. The Globe rules tax the accounting profit. If the expenses are there, but the tax rules of a certain country do not admit those expenses, then we have a permanent difference.
No,
It
but
all comes down to a permanent difference or temporary difference.
No, but here in this case, Victor, for example, I have 100 dividend, 100 operating income. Let's say that I had for this operating income, I had, for example, to 300 revenue, 200 expenses, but within this 200, I had some expenses that relate to people that administer ACO, and those people also administer the participation in BCO. And will I be allowed to take this full 200 deduction?
Afraid to say that you're making the wrong question. It's not a question of getting the deduction. You get the profit, the profit, and there's nothing forcing you to add it back. So it's the opposite. The global rules, you would need to have a clear rule for you to add this amount back. If you don't find this rule, sorry, this is your profit.
That's the permanent difference rule. Yes, the answer is you can take the deduction because it's in the accounting profit, and you only make the deductions of Article 3.2. Leonardo went through all of those, and we cannot find this one. So it stays there unless it's a permanent difference. So if we are in Brazil, we can have the deduction, that's fine. But if we're in Germany, then it becomes a permanent difference.
I would still have a really hard time upholding that you can deduct the corporate income tax related to the dividend income from the operative income. I would really have a hard time.
You are not deducting simply, since you're not offsetting, it is an expense. I mean, the withholding you had abroad, it's an expense for you in your books. There is no rule saying add it back. Sorry, these are the rules. I know everything in you say the opposite, but global rules are the rules. So what you are going to do this night, while I shall be working tonight also, don't worry. You're going to check and find a rule.
I really doubt that, you know. Let's move a little bit forward because we're almost out of time. Yeah.
The very good questions for Friday exam.
See, he's back. He's back. The operation was successful. So let's look at the allocation rules in a second. And we've already dealt a little bit with distributions. So as I mentioned, taxes on distributions are UPE's taxes, but they are reallocated to a constituent entity. Let's take a quick look at CSC rules. And again, keep in mind that, keep in mind that we're talking about, for now, IRR calculation, then I'll go into QDMTT in a second. So, for example, what is the allocation of CFC taxes, which is commonly called as CFC pushdown? So let's look at the first example here. I have ACO in a country that taxes income at 25% and BCO in a country that taxes income at 5%. And let's say that a country A has CFC rules that say, I will tax foreign CFC income regardless of it being passive or active if they come from low tax jurisdictions. And low tax jurisdictions, let's say it's defined as somebody that taxes lower than 15%. So all of BCO's income would fall within the scope of a CFC rules. So first, BCO will have a taxable profit of 50, and let's say a global income of 50 also to make things easier. It's all active income. It would pay a tax of 5%, so 2.5, and it will have a net profit of 47.5. Then what a country would do will be tax this income as a CFC income. So it would impose a 25% tax on the same 50, but it would also grant a foreign tax credit for whatever corporate income tax was paid in country B. Let's say that's how their CFC system works. So there will be a foreign tax credit of 5% of 50, of 2.5, a tentative tax of 12.5, which was 25% of 50, and then a net of 10, which would be the tax liability actually paid as CFC taxation in country A. So what happens there? Is this then a covered tax? Well, it is. Initially it's a covered tax of A Corp, collected country A. What the rules allow is to allocate this to B Corp when you are calculating B Corp's covered taxes. So it's basically a three-step calculation. You first calculate the 50, which is the income under the CFC rules. Then you calculate the tentative CFC taxation of 12.5, and then you offset the foreign tax credit. So you end up with 10, and this 10 will be considered in the example in full a covered taxes of B Corp. So when country A, if country A has an IRR, when it's calculating the IRR of the constituent entities in country B, this 10 will be considered a covered taxes paid there. Yeah. No. Yeah. Yeah, because no. Wait. The QDMTT in country B will not consider this push down. The IRR in country A will. So this is the thing. Then what will happen is that you have extra QDMTT. That's the problem. But then what we're jumping a little bit ahead, but the thing is, and let me go to the end, and I'll talk about the pushback later. The thing is, if country B has 3 minutes, should you can go to class. All right, see you tomorrow. If country B has a QDMTT, what is going to happen is that country A CFC tax is not going to be pushed down for the QDMTT calculation. And you have a QDMTT liability without the push down. Then the QDMTT is going to come up to country B and it's going to offset if everything works fine. It's going to come up to country A. And if country A CFC rules do allow, and they should, it's going to give a foreign tax credit to country A's CFC taxation. So the foreign tax credit is not going to be more at 2.5 anymore. It's going to be 2.5, the corporate income tax of country B, plus the QDMTT levied in country B. And because the QDMTT levied in country B, in this example, would probably be, so 15% of 50 is, yeah, 7.5, right? So the QDMTT would be 5. I'm already paying 2.5, and I'll pay 5 plus QDMTT. So this will all go up to offset the CFC charge of country A. And then what I'm going to pay in country A for CFC is not 10 anymore. It's going to be 5.
But
Then you don't have an IR. Then the only thing that's going to happen is a credit for the QDMTT. And that's foreseen under our law.
For example, if the company is a Brazilian company, and we will calculate the CFC rules before the key the MTT, so I can.
We'll give a QDMTT foreign tax credit. So our CFC rules say that, and they didn't even need to say that because it would be considered income tax anyway. But we do have a QDMTT tax credit. So whatever QDMTT is paid in country B, so it would be 2.5 plus 5, it would be 7.5. We'll give a tax credit for our CFC rules. And then if we had an IRR, then the surplus that we charge, because in this example, even if I have a foreign tax credit of 7.5, I will still have 2.5 charged as CFC taxation in country A. And then this 2.5 would be pushed down to B Corp for the calculation of the IRR in country A. That's my point. So you still have a push down, but not for QDMTT calculation, but for IRR calculation. Got it? All right, guys, now it's 8. So I'll try to get the rest done tomorrow. So tomorrow we have qualified refundable tax credit and the likes. First, Martin will speak, then Renee will speak, and then in the last hour I'll go back to this thing, and we'll probably wrap it up. All right. Thank you very much.